My name is Paul Deighan, and I'm here with Travis Gallant, and we're here to talk about the tax proposals that were released in the summer. The presentation headline is Private Company Tax Proposals an Update, and cutely or not, because in some respects there's not a lot to say. Having said that, we'll try and fill you in this morning on what was proposed, what was withdrawn, and then some of the mysteries around what's coming down the pipe. I've been with Grant Thornton here in PEI since 1989 and practiced tax full-time since 1996. Travis, a little bit in your background.
Yeah, thanks, Paul. I'm Travis Gallant, as Paul alluded to, a senior manager in the tax group with Grant Thornton here in Charlottetown, although obviously we service the whole island. Entering about my 10th year in tax practice, mainly focused on owner-managers here in PEI, and again, we're just here to speak to some of the updates or lack thereof, as Paul alluded to, with respect to some of the most significant tax changes we've certainly seen in recent memory, at least.
Okay. So without further ado, we'll get underway. So first of all, really in the summer, what the heck happened? What did the government do? So there were some proposals released on July 18th, 2017, right in the middle in the heat of summer. And quite frankly, when those were released, they sort of flew under the radar screen, given the time of year that it was. A lot of business owners were busy dealing with their businesses. And those of us in the accounting industry were trying to get some time off and didn't focus a lot on these. And so for a period of a good month to 6 weeks, there was very little feedback relative to the rules. There wasn't a lot said, there wasn't a lot of media attention. And then right around the end of August, things really started to ramp up as folks started to digest the rules, read them in some detail, and start to get quite worried about what they said. So then social media went pretty wild. There was a lot of the media interviews, a lot of stuff on the papers and in the TVs, and the real sort of backlash by the community. When the rules were released, they had a 75-day consultation period. That ended October 2nd. The public's backlash was part of the technicalities. So folks like Travis and I, we read the rules. We looked at the rules and said to our clients and the business community in general, hey, these are really broad. They're generally quite negative, and that wasn't good. A lot of the backlash, too, related to the tone the government took in delivering those rules. It had to do with the fact that there was a fairness component and that they were plugging loopholes. And that probably really wasn't true. In most cases, that the folks that we advise, they were following the rules to the letter of the law. This was more about changing tax policy as it existed for private companies than it was about plugging any sort of loopholes or addressing crookedness by taxpayers. So there were over 21,000 submissions to the Department of Finance, and then within 2 weeks after that, the government came out with some announcements. I do find it hard to believe that they digested all 21,000 submissions prior to their pronouncements in the third week of August, but nonetheless, that's what occurred. So there were a series of press conferences throughout the week, and then lastly, on October 24th, there was an economic statement. So right now, what we'll probably do is have Travis go through and review a little bit of what the proposals originally said.
Yeah, thanks, Paul. So in general, the proposals had three components with actual draft legislation and a fourth component just as some suggested changes in terms of what the government was looking at. So we'll spend a few minutes to take a broad overview of those three initial suggestions, starting here with the restriction on income sprinkling. So in general, income sprinkling is a legal method that exists today, and really it just has to do with getting an income stream that would otherwise be in someone else's hands to a third party, maybe a family member, at a lower rate. And so there's a plethora of existing avenues in which you can do that today, including splitting some RRSP income, some pension income, some CPP income, and the likes. The main swath of changes with regards to income splitting would have to do with income splitting through private corporations, which was one of the main one of the main targets of the federal proposals. Again, as Paul alluded to earlier, this is seen as more of a policy shift. Back in 1999, there was a kiddie tax regime that came into place, which was really to limit the ability to split income with minors at that time. So in 1999, although it was seen as an issue, there was a distinct decision made to exclude adults from those new rules that were put into place. So really casting these subsequent changes as a loophole is probably not correct in terms of it is actually a change in actual policy from certainly our view and a lot of tax practitioners across the country. So what are the ramifications of that? Well, the existing kiddie rules were to tax a dividend subject to those rules at the highest rate so that there would be no benefit in terms of trying to divert some income at that time. So the proposals as they stood at the time in July when they were released were to extend these rules to other members of society, being adults as opposed to minors. And so basically having more people subject to this regime is going to lead to some uncertainty in terms of how that plays out. And so the effect of that is to have a dividend that would otherwise be taxed at someone's marginal rate to now be taxed at the highest rate possible from the very first dollar. And again, these rules were, even though there might be some sound policy behind them, the pervasiveness and the complexity and the circular nature of the legislation just created an environment of uncertainty with respect to how these rules will come into play. In addition, with the level of taxation, there was also some recharacterization issues in terms of certain transactions being recharacterized for tax, leading to some unintended and negative consequences. That would be with respect to the income sprinkling. One of the second proposals had to do with a high-level concept, we'll call it surplus stripping. So in general, surplus stripping is a transaction that can be seen as converting what would otherwise be a dividend into a capital gain, which is taxed at a lower rate here in Canada. Again, these proposals, although there was some sound policy behind them, really the language was drafted so broadly that any sound policy kind of got overlooked because of the unintended consequences of the net being cast, in our opinion, far too wide. So some of the ramifications with respect to these proposals would be, inherent double taxation on various situations, a complete removal of the concept of integration in our Canadian tax system, which is the sound principle that whether you earn an income stream personally or through a corporation and then flow those streams to you personally, you should be indifferent in terms of those two methods. Significant impacts with respect to estates and family transactions. Again, there was various scenarios that could come into play in which it would result in double and potentially even triple taxation in certain circumstances. One of the final proposals that came with some actual draft legislation was the potential for some restrictions with in regards to the access to the lifetime capital gains exemption. So in general, the exemption was not going to be available for minors moving forward or for shares that were held in family trusts for those periods of time. And again, to the extent that the shares in which the gain was realized was subject to the income sprinkling rules that we just mentioned, there would be no exemption available in those shares as well. So again, the issue here, although there is potentially some sound policy issues here again, the legislation as drafted was very broad, and we were going to have our taxpayers faced with a situation in which you're making a tax decision as opposed to potentially an estate or family decision, and potentially not being able to mirror the two of those objectives together, so having to make some pretty difficult decisions if the rules were to be enacted. There was to be some leeway given in 2018 with respect to some potential elections and whatnot to use those gains if they would otherwise disappear moving forward. The fourth and perhaps debatable, most pervasive or most concerning was the concept of the corporate reinvestment legislation, or I'll refer to as the passive income taxation. So again, the concept of integration in general is that you are indifferent between earning income in a corporation or personally, And to that, in PEI, for instance, investment income generally in a corporation is going to be taxed initially higher than if you were to earn that money personally. So there is a disincentive in general to earn investment income in a corporation. The driver behind corporate investments is that to the extent your capital had come from an active business, which is taxed at a favorable rate here in Canada, again for various policy issues in terms of driving an economic growth and incentives for entrepreneurs, to the extent that investment capital came from those low-taxed business earnings, the government thought that, again, that was an unfair advantage as opposed to an employee's salary who, in general at the onset might have less capital to invest. Again, making an apples-apples comparison, which may not be appropriate, but that was the target that the government was trying to go after, essentially the deferral and the ability to have more capital to invest in a rainy day fund. So again, there was no legislation, unlike the three previous things we mentioned. It was more of a discussion paper with two broad kind of options the government was thinking of, one of which they noted was, they looked at it back in, I believe, the 1970s and was deemed to be too complex at the time. So even back in July, we're under the understanding that that first option wouldn't be followed through. The second option, pretty significant in terms of a wholesale change to the concept of integration, which is so fundamental to our private company taxation here in Canada. So you would be losing some certain valuable tax attributes. For instance, let's say a capital dividend account, which ensures that half of a gain that's taxed in a corporation can flow out to the shareholder tax-free. That makes sense given that if you have a capital gain earned personally, you're only taxed on half of the gain. So some of these changes, again, are a wholesale change to the concept of integration. And we believe that those would be very kind of complex to implement. So that's kind of a snapshot of where we're at. I'm going to pass it off to Paul, who's going to speak to, again, some of the updates that have come out since then from finance and where we're headed.
Thanks a lot, Travis. As you can see, those rules were pretty broad. They affected private corporations and their owners in a variety of ways in terms of the payment of dividends, the impact on estates, and capital gains, and when folks actually sold their businesses. So as mentioned at the outset, there was a pretty large response by the business community, and I think it's appropriate at this time to give a shout out to the Chamber and the business community in general for rallying together and providing submissions to the government on very complex legislation. I have to say, I have been in tax since 1996, and I'm not afraid of rule changes. I've lived through like 21 federal budgets. There's always a rule change, and there's always a reason for it. But this goes far beyond. This really related to tax policy and not just tweaking rules or changing rates. So kudos to the business community and to the Chamber in particular for rallying to come together. So Travis, having recapped what was proposed, where are we? Where do we stand right now today or at this moment? On income sprinkling, something is on the way. There are going to be rules that are going to restrict income sprinkling in some fashion. The government says that it heard the business community loud and clear, and it's going to simplify the rules. I'm not sure how they're going to do that. The government has said they're going to simplify them. I'm not sure what that means in terms of what the draft legislation will look like or how it will change from the way it was originally proposed. As we sit here today, this is in December of 2017, the rules for income sprinkling and the restrictions on them are still to be effective January 1, 2018. That's the communication that hasn't changed. So it's a little worrisome at this time and quite frankly frustrating to advise our business clients on what they should be doing. Given that the rules would go in January 1 and there would be restrictions presumably thereafter, the thinking is that right now any opportunity to maximize income sprinkling by paying or even increasing dividends that would be paid out to other family members either directly or through family trust, depending upon your corporate structure, may be prudent action. There's some thought, perhaps, that maybe, hopefully, fingers crossed, that the rules would be deferred a period of time, given that we are so late. The original pronouncement was the rules would be released sometime in the fall. We're actually not that far from the first day of winter, so we'll see how that unfolds. In terms of the capital gains conversions transactions, these are the ones where taxpayers would extract surplus from their companies, realize it as a capital gain, instead of what the government thinks should be a base position, either as a wage or a dividend. For reasons mainly tied to what was termed unintended consequences, these rules have been abandoned. And I would say that cautiously, I would say for now they've been abandoned. I think the government clearly has an agenda where they still want surplus to come out of a company in a certain way. Even today, as we undertake transactions, and given the business that Travis and I are in, we read about transactions and we read tax cases. And there is another rule out there. The acronym is GAAR, and it stands for General Anti-Avoidance Rule. It's actually a section of the Income Tax Act that the government will invoke when a transaction looks like it meets all of the technicalities otherwise required to be a good transaction, but in essence violates the spirit of the Act as determined by the Canada Revenue Agency. So that provision continues to be used to attack surplus stripping transactions. So most tax practitioners think that the government will circle back on these provisions at some point, and that this isn't totally dead. It'll be looked at again. From the viewpoint of a business owner being successful and realizing on their life's work, the capital gains exemption was a very important element of that. It allows the taxpayer to realize an $800,000 plus capital gain on certain types of property, one of those types of property being shares of a small business corporation, and have that gain be tax-free. So this was a big deal when there were restrictions imposed upon this. Again, as we sit here now, those rules, those proposals have been abandoned, completely withdrawn. But again, there's a huge but to that. I'm cautious because some practitioners would think there's a little bit illogical for the government to want to restrict income sprinkling through family trusts and share structures, and yet at the same time permit unfettered access to multiplying access to the capital gains exemption. So we'll have to see what the devil is in the details when it comes to the rules on income sprinkling, and if they try and slide something in relative to capital gains and any restrictions there. Perhaps I'll get Travis just to speak to now what's on the books for passive investments.
Sure. Thanks, Paul. So again, along with the announcements in terms of how we were going to move forward with the previous proposals that we just discussed, the government in October also came out with their intention to move forward with some legislation with respect to the taxation of investments in private corporations. Now, this is a bit of a Rubik's Cube in terms of trying to cipher the end game here, because unlike the previous proposals that we've just discussed that actually had at least a first draft of what legislation might look like, we had no such legislation drafted with respect to these proposals. So some of the comments I'll be making are just really based on some of the commentary that was in that white paper when it was initially published. So what we can glean from government's announcements so far are that they will be indeed moving forward with some legislation to limit the investment in passive investments, in private corporations. It is to apply on a go-forward basis only. So basically, on the government's own words, existing investments would be grandfathered. An arbitrary $50,000 a year threshold in terms of these new rules only applying above that threshold would be seen. It's noted that this legislation would come out with the budget. So typically our budget dates range from February to as late as April in any given year, so that's kind of the timeline. We're thinking about that. But again, lots of unknowns with respect to this legislation as well. So when will it take effect? It says on a go-forward basis, so presumably won't be retroactive, although we're not sure. The $50,000 threshold, we're not sure if this is on a per company basis, a per shareholder basis, associated group basis. So again, those are some of the unknowns. There's also, a plethora of other unknowns with respect to that threshold. So, in the simple instance where you have a company that has a rental property, and there's very little income over, say, a period of 5 years, and then there's a $250,000 gain. Well, do we get benefit for a $50,000, I'll call it annual threshold, or is it a use it, lose it type number? We're just not sure. What is being grandfathered? So only investments that exist today, or existing value that is in a current corporate group, or existing retained earnings? Again, we're not really sure what exactly would be grandfathered. And if the income on those grandfathered assets, the second generation income we'll call it, so the income on income, if that would be grandfathered or not. Some tax advisors across the country are coming up with potentially in excess of 13 pools in terms of being able to manage pre-2018 capital, post-2018 income. Where did the capital come from? Was it taxed at a low rate? Was it taxed at a high rate? So, the complexities are certainly starting to raise some alarm bells with practitioners across the country in terms of being able to comply. Because at a base level, when simple compliance breaks and general practitioners aren't able to practice, I'll call it generic kind of tax planning that's existed for years, that creates a break in the system, and might drive some unwanted behaviors, including just evasion as opposed to compliance. So doing some sort of risk-reward analysis on the client side. I could certainly see some clients doing that as well. We're told that there would potentially be some carve-outs for venture capital and angel investors to ensure there's no detriment to those investment markets. But again, we don't know what that looks like. Brian Bloom, a former senior tax policy advisor in the tax legislation division of finance, anecdotally guesstimates that he would expect no fewer than 100 pages of legislation to deal with these rules in order of trying to rein in all the complexities and ensuring all the unintended consequences are dealt with. So, capital seeks certainty. So for sure, we're in a period of uncertainty in terms of trying to get ahead of the game and get something grandfathered. Clients are going to be left in a position where they're going to be having to weigh the risks of trying to be proactive with the risks of the uncertainty in terms of the net that will be cast on this legislation that we don't know what it looks like today. So that's kind of where we're at with the passive investment proposals. So really we're in somewhat of a wait and hold pattern until we get some clear guidance with respect to those rules. Paul.
Yeah, I might just add to that, Travis, in the sense that we'd love to be able to give you some planning nuggets, but it's extremely difficult with no legislation. I've talked to the folks in my office, and one person was asking me, well, if the idea is that some passive investments are going to be grandfathered, i.e. not subject to the new rules, perhaps a valid planning strategy would be to borrow, let's say, $1 million, use that $1 million to go out and buy more passive investments, increase your passive investment pool prior to the rules coming in place, and boom, aren't I smart in doing that? The difficulty with that comes back to what Travis alluded to, is defining what's going to be grandfathered. If they just look at the gross value of passive investments, that kind of strategy might work. But they might define it and say, well, it's the passive investments less any borrowings to have those investments there. They may look at it and define it in terms of the retained earnings, in which case messing around with assets and liabilities will do nothing. The strategy wouldn't work. So it's almost impossible to give any valid advice about these rules. And they are going to be extremely complex. Mr. Bloom, who talked about there being potentially 100 new pages of legislation, he's also on record as saying that the Department of Finance historically doesn't care about the complexity that arise to taxpayers in enforcing rules, that the Department of Finance will simply treat this as an intellectual exercise and come up with new rules as they see fit. and the taxpayers and their advisors will need to then deal with the complexities. So going back to the announcements that were made in October by the government, there was a bit of a bright line announcement by the government in the sense that they're going to decrease the small business rates. These were previously proposed by the other government, the Conservative government. The Liberals put these on hold when they were elected, and now they've rejuvenated them. So starting January 1, 2018, the small business rate will decrease by 0.5%, and then another 1% a year after that. So in total going down 1.5% by 2019. So what that means for PEI businesses on a combined tax rate basis is currently on small business income, that's small business income on the first $500,000 is taxed at 15% currently, and it's going to 13.5%. But with every sunny day, it's typically followed by a rainy day. So because the small business rates will be decreasing, the government, through the concept of integration and how taxpayers pay taxes on those rates, there will be increases in dividend rates coming out of the corporations. So that essentially today it's almost 44% for a high rate income earner to take dividends out of their company, and that will be in excess of 45% come 2019. So in essence, that's all the announcements the government came out with. So just a really short recap, just to sort of go through everything. On the income sprinkling front, there are rules coming. They're supposed to be effective January 1. We don't know exactly what they're going to look like. Some consideration you may have is accelerate any income sprinkling ideas essentially now. Conversions of capital gains to dividends, those rules have been abandoned. They're off the books. Any restrictions on the lifetime capital gains exemption we think are off the books. They've been abandoned. There are going to be some very complex rules relative to corporations holding passive investments. And so we wait with bated breath until 2018 to see what they look like and to even see when they'll be effective. There is a reduction in small business rates, which takes place essentially almost immediately, which is positive for business. But to the extent that money flows through to shareholders, it will increase rates. So thank you, and have a good day.